Home Depot. Is this a stock you should buy right now? That's what we're going to try to answer here in this analysis video. I like to simplify things, and I'm going to discuss 6 metrics in this analysis: earnings growth, PE ratio, dividends, return on equity, free cash flow, and intrinsic value. They're then put on a 0 to 99 grade scale, so it's easier to visualize the different numbers I'm going to throw at you in this video. The first 5 metrics mostly deal with how good of a business we have. There's no point investing if there's an undervalued piece of crap before us. That's why I save intrinsic value near the end. Earnings growth is by far the most important metric. A company that doesn't grow doesn't survive for long. Home Depot has average growth at 3.65% per year looking forward. Not what I'm looking for, but there's always room elsewhere. For PE ratio, most people look at its valuation metric. I don't base my intrinsic value on the PE ratio. The PE ratio to me is a measurement of hype. Too high and there's just too many eager eyes on the stock. Too low and we might have a hidden gem. Home Depot has an okay PE ratio at 19.88. An average amount of hype, not too hot, not too cold. Of course, I would still want to see some bad news to scare away any weaker hands. Dividends should be an obvious metric and something a lot of people ignore. I'm going to put it out there. If you buy a stock that doesn't pay you anything, you're speculating. You're not investing. Home Depot has a pretty good dividend yield at 2.56%. Lock up this rate just in case the stock skyrockets. But we're not done yet. For return on equity, it tells me a lot about the management. It shows me how efficiently my investment dollars will be treated if I were to buy the stock. Home Depot has disappointing management with an ROE of 2%. Sure, they're leveraged, but they really need to do something with their cash management. Free cash flow is my way to quickly evaluate how dominant of a company we're dealing with. The more cash available, the better opportunity to buy up other companies, the better to research, and more money for marketing. Home Depot has a little bit in its war chest, to the tune of $11.49 billion. That's an okay amount of cash considering that Home Depot is essentially a duopoly with Lowe's. Okay, as I said, those 5 metrics we just went over tells me what kind of business we're dealing with. With a business grade of 54, the intrinsic value needs to be good to improve the overall grade, or else we're looking at an average business here. But before we get into our intrinsic value, consider joining my Patreon and get access to every grade from every company I've analyzed. It's updated all the time. Go to patreon.com/GrowthShares or click on the link in the description. As I said, intrinsic value can greatly help or hurt the Home Depot, and fortunately we're dealing with an average company. Nonetheless, the Home Depot is worth $205 per share. Right now, quite an expensive stock we're dealing with. And now that we've got all the numbers down, we need to put it all together and get our final grade. The Home Depot has a final grade of 47, and that makes it a below average long-term investment. For me, that grade is just too low. We can blame the price for the grade. Business is fine, but it would be more attractive if the price dropped quite a bit. But hey, after this video comes out, anything can happen in the next few days, weeks, months, even years. But long term is always longer than you expect. Keep this in mind. It took Warren Buffett 45 years to become a billionaire. Invest wisely, and as always, take care of your money.